Hi, everyone. Welcome to the Regulatory Development and Technical Accounting Update provided by RGP. I'm Janis Parthun, and in this session today, I'll be highlighting the regulatory and standard setting developments as well as recent accounting updates. And a little bit about myself. I'm a finance and a risk leader here, a VP within our Project Consulting Services team at RGP. And I currently lead our thought leadership programming and service innovation on emerging finance and risk issues. And I'm also the ESG consulting services leader. And a little bit about RGP. RGP is a global consulting company that serves over 2,200 clients, which includes over 3/4 of the Fortune 100. RGP enables rapid business outcomes by bringing together the right people who together create transformative change, and daring to work differently to deliver the future of work today. Now, I want to just be able to provide a little bit disclaimer. The views expressed in this presentation are those of mine and does not necessarily reflect the views of others, and that these slides are for educational purposes only, and they're not intended to be relied upon in terms of as official professional advice. And then just a little bit in terms of these updates, these, at least annually, these are updates that's provided from the AICPA and the CIMA conference. And so that is something I'm going to highlight just briefly, and then having to highlight the regulatory and standard setting developments, and then focus on a few key topics, and then at the end wrap up with a PCAOB update. But before we start, let's start with the first polling question. And this is just so I have a little bit of understanding who's in the audience here today. So with that, if you don't mind answering, which organizational function do you currently represent? Is it finance, internal audit, legal, audit committee or board member, or other? So we'll just give it a little bit, give it within a minute for you to answer. And we tend to have a large finance and internal audit representation, so just want to be able to confirm that is the case. Oh, great, thank you. So we have a pretty significant finance representation with a portion internal audit, and then others. So great. Thank you for answering that. Now, just to provide a little bit of background, this is an annual conference that the AISGPA and the CIMA host on current SEC and PCAOB developments. And so it really is where key stakeholders gather to discuss updates on latest accounting and reporting issues that impact public companies. But a lot of times there's also with a significant FASB representation, which also then impacts private companies. And this conference is held annually on December. And then also the last thing I just want to emphasize is that what I have in the presentation doesn't necessarily, it's not inclusive of all the topics discussed, but it is relevant from the events happening. So, all right. So let's jump in to regulatory and standard setting developments. And so before I dive into the developments and updates, I usually like to just start by providing background and clarity around the different departments within the SEC divisions and offices and their objectives. And we'll be referencing the specific groups from time to time as well. And now ultimately the SEC's role is to be able to protect investors and to be able to facilitate market formation. And this includes having oversight responsibilities over standard setting bodies, which includes FASB. And because the SEC has the power to enforce with the public companies, but the responsibility also does impact private companies and nonprofit organizations through FASB. And so I do tend to start with what the SEC is doing. And as well as including from a standard setting perspective how that impacts. Now, in terms of within the SEC, the OCA provides consultation on accounting, financial reporting, and audit concerns, questions, especially those that's involving unusual or complex or innovative transactions when there's no clear authoritative guidance that exists on issues. And then the DCF oversees corporate disclosure compliance with the securities laws and SEC regulations, and it's required to review each of the company's filings every 3 years as required by the Sarbanes-Oxley Act. And then the SEC staff from the DCF may provide comments in response to those filings, and these comments are often referred in correspondence as comment letters. Excuse me. And if the company is conducting something that's significantly misleading, then there's the Division of Enforcement, which then conducts the investigation into possible violations with the federal security laws and prosecutes in terms of the Commission's civil suits in the federal courts. Great. And so with that, with the SEC's rulemaking activities, I just want to be able to highlight a couple items here. So you can see here in terms of the SEC agenda list, there's a total of 42 proposed rules on the agenda list in terms of essentially kind of what they're forecasting to propose or finalize. And many of the proposals actually more directly impact the trading and investment community, so more so, excuse me, around the financial services. And so for public company preparers, the key ones to highlight are really led by the Division of Corporate Finance, the DCF. And so for the DCF, for the 14 new or pending rules that's listed here, 7 are led by the DCF. So there actually will be quite a bit more rules coming up that's going to impact the corporate preparers coming up in the near future. I've also, excuse me, I've also listed recent final rules here and just wanted to note the proposed rules pending that will have significant impact, but I'm also going to elaborate more under the key topics section of today's session as well. So I just wanted to initially call this out, at least from an SEC perspective. The other aspect that I do want to bring up is that the SEC staff also shared their emphasis on certain key topics during the conference that's noted here. And one is on segment reporting. And so I'll also touch upon this a little bit under the FASB section, but it was interesting to hear in terms of FASB communicating the new update on segment reporting and then also the SEC's response. And the key thing here is that with regards to FASB's new update, the SEC had suggested that if a company adopts the segment reporting and then disclose additional measures of segment profit or loss that's provided to the chief operating decision maker, but it's also not calculated in accordance to GAAP, then this is essentially a non-GAAP measure, which then needs to follow associated SEC guidelines. So if companies are planning to adopt this in the very near future, they really need to consider implementing this and suggesting just to monitor for any further developments by the SEC, because essentially you also have to follow, along with FASB's new update, you also need to consider what the SEC has already proposed and put out regarding non-GAAP. So in terms of fair value of measurements, the SEC staff also wanted to bring attention to the multiple matters around this. And this includes, one is crypto assets. So having to have possibly caution in implementing the FASB recent accounting for disclosure of crypto assets, the key consideration of determining the principal or the most advantageous market. And because you have to be able to determine this in order to determine the fair value. And it can be challenging because crypto asset market is still evolving and changing. And so companies really just need to be thoughtful about this as they're determining this. And then the other aspect is around loans. So for the measurement of loans and the related allowances for credit losses, the SEC staff noted that loans that are held for investment do not necessarily meet the definition of the debt security under ASC 320, should be measured at amortized cost and assessed for expected credit losses. And then additionally, collateral dependent loans really need to have further consideration, such as the liquidity of the collateral. So those are some key topics that the SEC wanted to emphasize during the panel discussions at the conference. Now, transitioning to the standard setting perspective, I wanted to highlight some of the FASB's activities. And there are currently multiple projects on FASB's technical agenda, and several projects actually recently completed, two I had mentioned just earlier. And so I'll highlight the completed ones in the next slide, and then as well as some of them, I'll go elaborate a little bit more in the key topics area. The one I wanted to mention here, though that's an exposure draft and in the board deliberation stage, that is the disaggregation of income statement expenses. And the objective here is to improve the disclosures about a public business entity's expenses by providing more detailed information by certain types of expenses, such as employee compensation, that are included in expense captions commonly presented on the income statement, such as cost of sales. And they had a public roundtable held back in December. Now it's followed by board deliberations. So I would stay on top of that, just continuing seeing what changes may be happening. In terms of IASB, at the conference, they had Linda Mezon-Hutter, the Vice Chair of IASB, present at the conference on the IASB priorities and projects. And she really brought up three key efforts. One is the primary financial statements. So IFRS is expecting to publish the accounting standard pertaining to general presentation and disclosures in the first half of 2024, this year. And the intent here is to improve how information is communicated in the financial statements with a focus on information in the statement profit or loss and replace IAS 1, presentation of financial statements. And this will be effective for annual periods beginning on or after January 1, 2027. So there's a little bit of time. In terms of the other priorities, she also wanted to emphasize the relationship with IASB. And so the ISSB, the IASB continues to work closely with a wide network of advisory committees and bodies and representing different stakeholder groups. And this includes the ISSB. As now the International Sustainability Standards Board is under the IFRS and ISB standard setting body, and so they are definitely working closely in terms of activities that are happening. And the third one is the post-implementation review of IFRS 15, revenue with contracts with customers. And the majority of the feedback received were that the IFRS 15 didn't necessarily require fundamental changes, and that the convergence of FASB ASC topic 606 would also be very important to consider as part of this effort. Now, I'll go into a little bit more detail on the FASB updates next, and then provide the summary on the PCAOB at the end of the presentation. So with that, so this is the listing of the most of the FASB updates that had occurred in 2023 last year. And just in terms of looking on the technical agenda calendar recently or yesterday, there hasn't been any new ones that's come out yet. So this is really essentially the most current list that we have at this time. So I'll start with ASC 2023-02 investments, equity and joint ventures. And with that, really the objective here is to be able to consistently account for equity investments made primarily for the purpose of receiving income tax credits and other income tax benefits. And you can see here in terms of the effective dates for public companies, December 15, 2022, and then all other December 15, 2024, and then having to include interim periods with the years noted. All right. And then also we have ASC 2023-05, joint venture formations. And the objective here is to reduce the diversity in practice. FASB is requiring that a joint venture apply a new basis of accounting upon formation and recognize and initially measure its assets and liabilities at fair value with few exceptions to the fair value measurement. And then this is applicable to entities with formation dates on or after January 1, 2025. In terms of ASC 2023-06, this is not new guidance, and really the purpose is to align what FASB and the SEC has issued, so there's really no transition or effective date. It's more of a catch-up. For ASU 2023-07 segment reporting, which I had just mentioned a little bit earlier, the objective is to improve disclosures about public entities' reportable segments and address requests from investors and other allocators of capital for additional or more detailed information about a reportable segment's expenses. And the key amendment in triggering this is to require that a public entity disclose on an annual and interim basis significant segment expenses that are regularly provided to the Chief Operating Decision Maker, the CODM. And it's applicable to entities starting December 15, 2023, and then to include the interim periods in the years noted starting after December 15, 2024. Now, the next one here, ASU 2023-08, intangibles, goodwill, other, and crypto assets, which is what I had just also mentioned briefly as well. And the objective here is to require that an entity measures crypto assets that are within the scope of this ASU at fair value each reporting period with a change in the fair value recognized in the net income. And amendments also require that an entity provides disclosure on significant holdings, contract sale restrictions, and changes during that reporting period. And this is applicable where the crypto asset does not provide the asset holder with enforceable rights or to the claims on underlying assets or services, and are not the ones created or issued by the reporting entity itself or the related parties. This is applicable to entities starting December 15, 2024, and then to include interim periods within those fiscal years. And then we have ASC 2023-09, income taxes. And the objective here is to be able to improve the transparency and the decision usefulness of the income tax disclosures and report enhanced information around the individual reconciling items on the rate reconciliation by nature and jurisdiction, income taxes paid by jurisdiction, and it's applicable to entities annually for public companies December 15, 2024, and all others December 15, 2025. Okay, I know that was a lot to cover, and now I'm just going to dig a little bit deeper on some of the highlights with key topics. But before that, we have our next polling question. So with that, which topic is of the most significant interest for you this year? And you can select all that applies. At least I think that's how it's configured for this polling question. So let's give it a try. And we'll just give it a minute. And then one thing I just wanted to mention at the AICPA conference was that ESG was actually a pretty significant topic, and how the controllership was getting involved. And then technology and data management were also really significant topics in terms of from a CAO and controllership panel perspective. So with that, I just wanted to take a quick look. Cybersecurity is very significant for the audience here, as well as internal controls and ESG, and then with digital assets and other coming last. Okay, great. This is very helpful. Thank you for answering that. And so with that, we are going to start with cybersecurity in terms of to address your polling results as well, or align with your polling results. So the first topic here is to highlight cybersecurity. It's a significant proposal in March of 2022, and the SEC had proposed rules and amendments to enhance and standardize the disclosures regarding cybersecurity risk management, strategy, governance, and incident reporting by public companies. And it is now official, finalized, and issued in July, effective starting September of last year. And to expand a bit more, the rule requires new Form 8K to report on material cybersecurity incidents within 4 business days of confirming materiality. So not necessarily based on the discovery date. And to be able to disclose under the regulation SK, policies and procedures, management's role, board of directors' expertise on how entities ID and manage cybersecurity risk, and then as well as reporting on prior material incidents. Now, the compliance dates have already kicked in with the regulation SK item 106, which is to disclose, or which is provide disclosure to describe companies' processes for managing cybersecurity threats, and started in terms of fiscal years on and after 12/15/2023. And then with Form 8K item 1.05, which is disclosure of material cybersecurity incident starting December 18, 2023. And then with inline XBRL having to have this tagging required 1 year after the initial compliance date. And then the small reporting companies, you do have an additional 180 days to comply on that. Now, I also just wanted to note and bring up that we had also released a recording back in October of last year to first address this topic. So there is an additional resource available as well. And I do have this as a hyperlink that will be available to you as part of the slide deck as well. So if you like more information, please check out the recording as well, and that might be able to give you some additional tidbits. All right. The other topic I'd like to highlight and introduce is ESG, or responsible business reporting. The topic of ESG is not new, and you can see here for background that there are significant funds and investments around this. I'm not going to go into this in too much detail because we have so much going on to present today, but really because of the wave of these activities, regulatory and standard setting bodies are paying much more attention. So to dive further into this topic, there are developments from multiple fronts in relation to financial reporting and annual filings. The SEC has already issued an amendment that requires businesses to include human capital disclosure and became effective in late 2020. In terms of proposed rules, the SEC has two. One is applicable to registrants subject to investors, and the other one applicable to investment community. And many people have been talking about the first proposed rule, and I will elaborate more on the next slide. But with the second one, the ESG disclosures for investment advisors, investment companies. The goal of the proposed rule is to determine whether the fund or the advisor's ESG marketing statements represent concrete and specific measures taken to address ESG goals and portfolio allocation. The proposal requires that investment companies and advisors to disclose their ESG strategy, present in a tabular format, and for environmentally focused funds to disclose the emissions associated with the portfolio investments. Now, in terms of the other rules, I also want to just call out that there are additional rules in the horizon. One is the human capital management disclosure, is to propose amendments to enhance registrants' disclosures regarding human capital management, and it's planned on the SEC's agenda for October of this year. And then corporate board diversity, propose amendments to enhance registrant disclosures about the diversity of the board members and nominees, and that is planned for the SEC's agenda for October as well. Now, from FASB's perspective, we have, we have the accounting for environmental credit programs, and this is on the FASB's agenda to assess requirements for participants in compliance and voluntary programs that lead to the creation of environmental credits. And the credits may include those created under the compliance program, renewable energy credits or certificates, renewable identification numbers, or carbon offset credits. And then as well as non-governmental creators of environmental credits. And really the focus here is on credits that are enforceable and traded. So it's not necessarily pertained to tax credits or investment related around, at least for this project. And the topic initiated here is because there's been diversity in practice without much direct guidance, such as whether transactions should be accounted for as inventory or a finite-lived intangible asset when purchased. And the initial decisions reached, at least within the FASB board, include the definition of what's considered an environmental credit and environmental credit obligation. And an entity would recognize an asset for environmental credit when it's probable that the credit will be used to settle an environmental credit obligation, or ECO, or if it's going to be sold. And the cost of other environmental credits will generally be recognized as an expense. There's more to come, but it's not in the exposure draft stage yet. And then the other is a research project, the definition of a derivative, previously referred to as accounting for financial instruments with ESG linked features. And just stay tuned on this one. It's currently still under research, so it's not in the technical agenda officially at this time. But you want to stay tuned in case it does get moved in there. All right. Okay, so now I wanted to dive a little bit deeper and focus from a U.S. perspective. I had mentioned the SEC, but then there are additional rules and laws to discuss that not necessarily pertain to SEC or FASB, but they're all climate focused and U.S. focused. So first, I'll just start with the SEC proposed rule. And as many of you are already aware, in March of 2022, the SEC proposed rule to enhance and standardize climate-related disclosures as in the investment community is demanding for more consistent and comparable and reliable information across companies. So I won't go into detail onto the requirements here, and many of this is listed in the table that's available to you after the webinar. But in terms of for large organizations or accelerated filers and large accelerated filers, there's the additional requirement to obtain reasonable assurance on the Scope 1 and Scope 2 emissions. So I just wanted to point that out. And the SEC proposed a phased approach for implementation. But again, this is proposed at this time. And the most sensitive for many of the public companies right now is really from the limited and reasonable assurance requirements perspective, estimating the financial impacts of possible climate-related events, and having to report Scope 3 emissions. So these are the major concerns. We'll want to stay tuned in terms of what the SEC ends up having to finalize with. And then Of course, for small reporting companies and non-accelerated, they're not listed here from an assurance requirement perspective, but will still be subject to controls and procedures, disclosure controls and procedures. And then when it comes to this information would also need to be tagged in line XBRL when it becomes final. Now, I've included the SEC proposed details as well as the RGP blog here for reference, so that's available to you after the webinar. I also included a recent RGP webinar as well that addresses internal controls. And so with this, many of us are monitoring the SEC's decision on next steps. And the most recent update on their agenda is that this is scheduled to finalize by April of 2024. Now, the other items I wanted to point out is in terms of California. So recently, California has issued 2 state bills requiring companies to report on their carbon emission-related activities ahead of the SEC's anticipated rule. And these are now officially signed into law. And with the SB 253, it's anticipated to apply to over 5,000 companies, public or private. So to dive a little bit deeper, you can see here from a requirements perspective, the SB 253 requiring disclosures of Scope 1 and Scope 2 by 2026 and Scope 3 by 2027. And then this is applicable with companies with revenues greater than $1 billion that do business in California, public or private. And it's aligned to the Greenhouse Gas Protocol framework and includes assurance requirements here. And then with SB 261, this is to disclose climate-related financial risk in 2026, and then afterwards every 2 years, and applies to U.S. companies that do business in California with revenue greater than $500 million, in alignment with TCFD. So wanted to note that wanted to point out that in terms of disclosing in 2026, this in turn means that you're actually having to gather your 2025 data so that you can disclose in 2026. So I wanted to point that out and keep in mind. And then for revenue, it's not just revenue earned in California. It's really all of the revenue that's applicable. It's more so in terms of what might apply in terms of doing business. And there's more details to come around that, but it could be applicable in terms of from a payroll tax perspective or from a sales tax perspective, but there are more details to come. And then in terms of what's next, the California Air Resource Board, or CARB, will be overseeing the reporting and compliance on assurance, and we'll need to roll out additional reporting guidelines for implementation. And then for SB 261, similar situation, the submissions will be reviewed by an advisory group within the governor's office, but more details will come as well. Okay. Now on the international front, this shift towards compliance is happening internationally and advancing further in terms of expanding the topic-wise further than the U.S. So the IFRS Foundation created the International Sustainability Standards Board back in 2021, focused on sustainability-related disclosures to help investors make informed decisions about ESG matters. And there are significant, excuse me, sorry about that. And there are significant progress since then. The ISB issued 2 standard cents in June of 2023, and this includes IFRS S1, General Sustainability-Related Disclosures, having to set out overall requirements for an entity to disclose, to communicate to investors about sustainability-related risk and opportunities that they face in the short, medium, and long term. And then the IFRS S2, Climate-Related Disclosures, building upon the recommendation of the TCFD, sets out specific climate-related disclosures and designed to be used with IFRS S1. And just want to note that while these standards are officially issued, they are not mandated unless the country or the jurisdictional authority decides that companies should comply. However, ISSB is working with jurisdictions and companies to support the adoption. So I would strongly suggest staying close to these updates on the jurisdiction. One other comment to add is that there's also a consolidation of voluntary standards and frameworks occurring recently, and with SASB, FASB being consolidated under ISSB back in 2022, and then the TCFD now rolled under ISSB this year. So a number of acronyms, but it's good to see the progress around that. We hope to continue to see that going forward. In terms of the EU, the European Commission has adopted the rule Corporate Sustainability Reporting Directive for companies to publish detailed information on sustainability matters to increase a company's accountability and prevent divergent sustainability standards, effectively fiscal year 2024. And the European Financial Reporting Advisory Group, or the EFRAG, is responsible for developing the European standards and have developed 12 associated standards that you can see in the picture here, issued in July. And I would say there are nuances to consider in terms of applicability, and this will be a phased-in approach for companies and require consideration of the entity structure as well as revenue associated. The range of the applicability starts in 2024 for EU-listed companies previously under prior non-financial reporting directives. And it extends out to 2028 for non-EU companies with business or subsidiaries that meet certain criteria to be required to report at the corporate consolidated level. One thing to point out that in between this range, certain subsidiaries of non-EU companies were also subject to report as early as 2024, but the European Commission recently approved to extend the timeline by 2 years to 2026 to allow time for implementation. Okay, so that was a bit on the ESG and responsible reporting. Now the other hot topic that I'd like to transition to is digital assets. Before we go into detail on digital assets, I thought I'd just provide a little bit intro on this, and I like how NASDAQ has explained these assets on their website as well. So from a cryptocurrency perspective, typically you may see Bitcoin or Ethereum as examples and what people tend to be hearing about. And in terms of asset-backed tokens, these may be, for example, gold or oil or real estate or specific investments as examples. And then when it comes to non-fungible tokens, there's been a number of artwork and media recordings sold as NFTs. So these are just some of the examples that I wanted to share. And then interesting enough, there's also the central bank digital currency, and it's a digital form of country's fiat currency or government issued, and it's issued and regulated by a country's monetary authority or central bank. And some foreign countries have it, for example, Bahamas and China have been piloting this. So there's a number of forms of digital assets. And so starting with the SEC perspective, the SEC has previously shared that certain fraud and investment claim scams related to cyber assets has increased. And of course, I think the big one that gained media attention is around the executives with the crypto asset trading platform company, FTX. Convicted with fraud with FTX going into bankruptcy due to leverage and solvency issues. So the SEC has been communicating on the crypto asset topic, and more specifically on entities who are custodians of crypto assets or exchanges that facilitate crypto asset trading, and then case-by-case basis for other situations. And at past conferences, the SEC has confirmed that the registrants should be accounting for cryptocurrency under intangible assets and have elaborated more across different scenarios. You can see here, April of 2022, the staff issued the Staff Accounting Bulletin, SAB 121, to provide firms and offer custodial services of crypto assets the directions on how to record those custodial services on their financial statements. So specifically entities who are just safeguarding crypto assets held for their platform users, the guidance recommends that firms record safeguarding liability and a corresponding asset separate from the underlying crypto asset at fair value. And I want to also add that the SEC emphasized the importance of having terms and conditions clearly disclosed to enable users of the financial statements to understand the rights of the crypto asset holder and the obligations. And then also bringing in specialists such as technology or law specialists, as these arrangements bring audit complexity and you want to be able to consider the variety of risks. And then along with SAB 121, digital asset was the #1 interest that FASB had received from the agenda feedback a few years back, and so it heightened the attention with FASB as well. And as a result, FASB has been working on this project and of course recently released accounting for and disclosure of crypto assets. And the objective here is to improve the accounting and disclosure for a subset of exchange-traded crypto assets and exchange-traded commodities. And as mentioned earlier, FASB issued ASU 2023-08, and the amendments of this update requires that an entity measure crypto assets at fair value in the statement of the financial position, each reporting period, and recognize the changes from remeasurement in the net income. This also includes requiring disclosure about significant holdings of crypto assets, restrictions, and changes in the holdings. And then the key update here as well is that this eliminates the previous annual requirement to test specific assets for impairment, so reducing the associated costs and the complexity of applying the current GAAP guidance. And then as mentioned earlier, this was issued in December and it's effective starting December 15, 2024. Now, in terms of other guidance, I also just want to point out the AICPA issued a practice aid back in 2021, and this is in the format of Q&A. And interesting enough, they've refreshed this throughout the years, so you can find additional insight if your organization is handling or in receipt of digital assets in general. So not necessarily trading, but if you're having to handle those transactions, it might be helpful also to take a look at the practice aid. What's helpful is that the practice aid includes a variety of scenarios that may occur and really helps you go through the evaluation process as well. Okay. So with that, and just checking on time. And with that, IPOs and SPACs. And so because of the significant volume of the transactions involving SPACs, or special purpose acquisition companies back in 2021, the SEC has issued a proposal in March of 2022 to enhance the disclosures for business combination transactions between SPACs and private companies, or de-SPAC transactions, and to address the treatments involving the reporting of the shell company and provide additional guidance on the use of the projections here. And there's been significant slowdown the last 2 years, so I'm not going to go into too much detail, but I do want to highlight the final rule that the SEC had issued recently as well, essentially last month. So the SEC had proposed a rule, again, a few years back, but it was recently finalized in January of this year, and it's to be effective end of May, or 125 days after the issuance. And this includes disclosure requirements on compensation paid to sponsors, conflict of interest, dilution, and for de-SPAC transactions. So having to consider the board of directors of the SPAC involved and whether the transaction is in the best interest of the SPAC and its shareholders. And then this also includes additional financial statement requirements for business combination transactions that involve the reporting shell company, such as a SPAC. Now, from the OCA, the SEC's OCA consultation perspective, the issue continues to be accounting between debt versus equity. And so I listed some resources here for you in terms of reference if this is a topic that pertains to you. And then the FASB has also previously issued ASU 2020-01 pertaining to equity as additional guidance as well. And then from a DCF perspective, their previous emphasis was on the importance of disclosure of the financial incentives of the SPAC sponsor to complete the transaction, making sure to include potential conflicts of interest and the risk to the shareholders who continue to hold the shares after the SPAC merges. So you can also see here for additional guidance in terms of from a FASB guidance perspective as well. Okay, so with that, we have the next polling question. So are you currently aware of the top trends from the SEC comment letter feedback to public companies this past year? And so we'll give it a minute or so. And as we are coming up on time, I want to just make sure we have enough time to speak to this as well as the PCAOB updates. So, okay, no, that's great. That's what we have on the next next topic of the agenda. So I am going to transition to that. So top comment letter trends. So this is, there's usually a top 10, but I'm just going to highlight really the top 3 and then also from an internal controls perspective, highlight that topic. So this is in terms of what the SEC's DCF has focused on and issued comment letters as they review companies' filings every 3 years. And these tend to be the top trends. There tends to be a top 10. And a number of firms accumulate this, but it tends to happen on an annual basis. And so really what I tend to do is having to share this in terms of how it might impact you as a public company, or just having to consider that from a private company perspective, what might be of concern. So here, wanted to first cover the first one, the management discussion and analysis, or MD&A. Some of the common themes around this is results of operation and critical accounting estimates. The initial trigger here is the amendments to the regulation SK, which heavily involves MD&A focus to modernize and enhance the disclosures. But since the amendment, the DCF has consistently had concerns around companies' approach on critical accounting estimates. And then also for non-GAAP disclosures, which is number 2 here, the themes observed tend to be either the prominence of non-GAAP measures. The SEC has referred to this, its compliance and disclosure interpretations on non-GAAP financial measures for examples and guidance about approaching this. And also explaining that when a registrant presents a non-GAAP measure, it really needs to present a more, also the most directly comparable GAAP measure associated with equal or greater prominence. And the key point here is that the GAAP is the foundation and should be the focus. Also, mislabeling of measures. So one example shared was labeling of contribution margin, a non-GAAP measure used in place of a gross margin. Performance metrics. If metrics are included, disclosures should also be included, such as a clear definition of the metric and how it's calculated. Statement indicating the reasons why metric provides useful information to investors. and then statement indicating how management uses the metric in managing and monitoring the performance of the business. The DCF communicated that the importance of being consistent on how the metrics are calculated, as well as maintaining proper controls and procedures. The Commission also provides additional guidance on this topic, which I've included the link here. And then for segment reporting, of course, we talked about that quite a bit, but I'll also re-emphasize again. So the DCF have communicated common themes that raise concerns. Identification of the operating segments. The operating segment should be tied to the entity's decision makers' use of financial information to make decisions about operating matters. The DCF indicated that staff are likely to comment when an entity only has one reportable segment when there are changes in the business structure shared publicly that suggest otherwise. Aggregation of operating segments, criteria and quantitative threshold defined in ASC 280 needs to be considered to determine whether to aggregate operating segments into reportable segments. Changes in reportable segments. If composition of the segment change, entities should restate segment information from prior periods for consistency for the period. And then DCF noted it's important to include a revised segment footnote if the reportable segments change. And now with the FASB ASU on segment reporting release, the guidance will address some of these concerns. I also have this one in terms of from the risk management audience here. The themes include the concerns that SEC had commented on is evaluating the severity of control deficiencies. So not just individually, but in aggregate when there are multiple or in context, such as triggering an immaterial restatement. Are deficiencies appropriately identified in the COSO components other than control activities? Disclosure of material changes, so not using boilerplate disclosures, suggesting no changes have occurred, or if a material weakness noted contains enough description to be understood. And then conclusions on ICFR after a restatement. Since a restatement is typically a sign of a material weakness in ICFR, even if the restatement is immaterial. So that addresses our top comment letter trends. And just for time purposes, I'm going to skip the scenario, but you'll have the slide available to you in terms of one of the situations that the SEC had handled. Now with PCAOB updates, and we have also the last polling question here. So besides the financial statement matters, what other areas did the PCAOB increase inspection focus for 2023? This could be accounting for digital assets, the risk of fraud, and internal controls, or all of the above. We'll give you a few minutes to answer that, or 1 minute. And with about 5 minutes remaining, that's what we'll wrap up with from a PCAOB perspective. All of the above. Great. All right, let's move on here. So with the PCAOB updates, the PCAOB have had a very busy year. The PCAOB inspects over 200 audit firms and reviews over 900 audits annually across the globe in terms of audits conducted pertaining to public companies. And what I wanted to initially highlight is in terms of the PCAOB priorities for 2023, as well as their focus for 2024. So from the conference itself, they had expressed in terms of focus on the risk of fraud and looking at what auditors are considering, such as evaluating the design of controls that are intended to address risk of fraud, consider how fraud could be concealed in disclosures or any significant unusual transactions that pertains to the business. And then considering the responses of inquiries of management and the audit committee for possible illegal acts, and inquire whether management has received tips and complaints. Excuse me. And then in terms of other risks, such as digital assets and financial services sectors, these were their focus areas for 2023, as well as firm independence here. And then in terms of inspection results, I've listed 6 financial statement areas here and wanted to call out some of the deficiencies. But really, many of them actually pertain to ICFR, as well as the testing of estimates and the reliance of data and reports. So I've listed these key things here, and then also for 2024, the priorities for PCAOB is really still having to consider the inflation and the high interest rate that's been occurring, the risk of fraud, and then the auditor's response to complex activities occurring at the company's operating structure and business processes. And then also, interesting enough, auditor's response to company's IT environment, because it's as company's IT environment is becoming increasingly complex. And then in terms of official publication, the PCAOB had last summarized results in July of 2023 with multi-year observation trends that includes the 2022 inspections. And so that is also what I'm going to share in the next few slides, because that is also publicly available and published, and so wanted to at least share from a multi-year trend perspective. So from the internal audit over financial reporting perspective, for the risk and compliance audience here, it's interesting to see the yearly deficiency trends by topical area and the nature of deficiency. But I would want to just highlight in terms of the areas that generated the most comment forms is 3 types of deficiencies. Testing controls with the review element. This is insufficient evaluation whether controls with the review element selected operated at level of sufficient precision, such as procedures to identify items for follow-up and to determine whether those items were addressed. And then identifying and selecting controls to test, whether controls identified and tested were not relevant to the assessed risk of material misstatements. And then identifying and testing controls over the accuracy and the completeness of the information used in the operation of a control, essentially population. And this is a critical error when deficient because of control reliance. So here, figure 11 here illustrates the financial statement audit areas in which our ICFR comments relate to. But I thought it was interesting, just wanted to point out that information technology included here, and the number increased to 10% from 2022 inspections. So pretty significant increase on that. So with that, I have here also in terms of financial statement deficiencies, that's available for you to take a look after the presentation or when information is available to you in about a week's time. But with that, this concludes our session for today. And if you have any specific questions about the presentation, we'll respond back to you and get back to you if it's not addressed during the session. So thank you for your time. Appreciate your attendance, and have a great rest of the day.